assets?
Well, I don't argue against that, and Mr. Cooperman has a decent argument. I've just argued that in terms of confiscation of capital. There are several reasons to be cautious, however. One, comparing Treasury yields to corporate stock dividends, it spans a huge gap of risk, AAA for Treasuries and an implied BAA and lower for subordinated stocks as investment instruments. Secondly, stocks can go down too, just like bonds, and we certainly saw that in 2008. And third, demographically, boomers prefer certainty as opposed to speculative capital gains, and so there's an element to that. Just as an example, this morning in the paper, it was pointed out that Ford is shifting billions of dollars a year from their equity portfolio into bonds. Now, why would Ford do that? Doesn't Ford know that their capital is being confiscated? They're doing that because of the certainty, because of locking in their liabilities relative to their assets, even at a low 2 to 3% rate. And so boomers, from the standpoint of individual investors, are the same way. They're beginning to get older. They're beginning to require more certainty. And yes, do they find an appeal in a Johnson & Johnson at 3.5% dividend yield with growth potential? Sure they do. But they also believe that they want that money back, and that if there's a 2008 and 2009 scenario, perhaps they won't. So there are demographic trade-offs here that have to be considered.